Well, Canada's job growth stunned on Friday, coming in triple what was expected, more than triple, in fact. And this had the market rethinking whether or not or when we might get rate cuts. Certainly, it was priced in two-thirds odd that the first rate cut would show up around June. Now those odds are less than half. Our next guest says we should be seeing a rate cut in this country now. Jim Thorne is the chief market strategist at Wellington-Altus Private Wealth and joins me. Thanks so much for joining me.
Nice to see you again, Anne.
Now, you don't often take the headline data. You like to get right into the weeds. So tell me, what's the data that you're looking at that informs the need for a rate cut now?
Well, I don't think 50,000 K in part-time jobs is strong. I don't think 26,000 public sector jobs is strong. I don't think a labor market that can't keep up with Trudeau's immigration policy is strong. I don't see the wage inflation or the Phillips curve that everybody's talking about. I see a private sector buckling under extreme tightness of the Bank of Canada. And if we get some policy constraint from Ottawa, we're going to see a growth scare going forward.
And how many rate cuts do we need to solve that?
Well, that's a great question. So first off, the yield curve is inverted, more inverted in Canada than in the United States. So the Bank of Canada, if you use the 30 or the Bank of Canada overnights in the 30-year, 150 basis points just to get back so that it's not inverted.
Wow.
That is more extreme than the United States. So what I find interesting up here, or in Wall Street as well, is people think that cutting 25 or 50 basis points is going to do something. Amber, we're in your parents' backyard. It's in the summertime. We're playing with the hose, and we just kinked it so the water doesn't come out. If we just move it a little bit, it doesn't matter, right? Until the short end of the curve gets significantly below the long end of the curve, can credit creation get back into the private sector? Are
you talking about 6 rate cuts? If I did my math, would you do a quarter point every time? 50 basis
I would. So typically what happens is rate cuts, it takes longer for them to happen. And then when they do happen, because they are always late, they happen more aggressively and they go deeper. So I'm still going for a 2.5% Bank of Canada overnight rate by the end of 25, yes.
By the end of 25?
By the end of this cycle, yes.
Does housing make you stop short at all on that? Because is that a complicating factor that you don't want to add more fuel to a housing market?
Rate hikes are causing shelter inflation in the country. Fine, let's leave that over there, and we've talked about that ad nauseum, you and I. What I find interesting is on the rental side, how the Bank of Canada thinks that keeping rates high solves the rental problem. In fact, it exacerbates the rental problem. Let's look at the building permits that just came out today, which are below historic averages. So where I'm at is I think the Bank of Canada has to leave the housing over here and look at the private sector and look at the long-term growth. I do not see any difference in this cycle than I did going into the global financial crisis. And if the Fed and the Bank of Canada do not cut now, it is going to get very painful coming down in the next couple of years.
We're not an island. We have to talk about it in context with the U.S., where the mantra is higher for longer.
Right. So what I think the big thing for me is, look, there is no relationship, there are no facts that support the straw man argument, the simple straw man argument up here, that the Bank of Canada cannot move before the Federal Reserve. There is no data that supports the fact that interest rate differentials affect currency crosses over the long term.
But it does perhaps at a moment in time, whenever traders decide that's the factor driving the currency.
Could be for a week or so, but if you go back and use monthly data, I'm going to use a statistic, there is no R square. There is no relationship. And I could easily paint you a narrative where, because Canada is so much more interest rate sensitive, right? If the Bank of Canada cuts rates more aggressively than the United States, the dollar could go up because the economy would recover faster than the United States, because the United States on the private sector side is not that interest rate sensitive.
So the loonie doesn't plunge to 50 cents, say. Which
no, but you know, you're right.
Yeah.
Could you get a knee-jerk reaction? Well, you watch the markets on a daily basis, sure, but over the long term, well, let me put it to you this way. Interest rates in Europe are lower than the United States, but yet the euro trades at a premium to the US dollar. The yen, the Japanese yen, has had the biggest era of deflation or depreciation, and inflation hasn't gone up.
Yeah.